Think of a bank like a safe place to keep your money. You deposit your hard-earned cash, and they keep it secure for you. You can withdraw it when you need it, like for groceries or that new phone you've had your eye on. But what else happens to your money while it sits in the bank? Here's where it gets interesting. Banks don't just hold on to all your money. They use a system called fractional reserve banking. It's a big term, but the idea is simple. Banks are required to keep a fraction of your deposits in reserve, just in case you want to withdraw some. This reserve is typically a small percentage of the total deposits. The rest of the money, they lend it out to other people and businesses. Let's say you deposit $1,000. The bank might keep $100 in reserve and lend out $900 to someone who wants to buy a car. Now, that person's car dealer deposits the $900 into their bank account. Guess what happens? The bank can then lend out a portion of that $900, keeping some in reserve. This process repeats over and over again, with each loan creating more deposits and therefore more loans. This cycle of lending and depositing is how banks essentially multiply money in the economy. It's like a ripple effect, with each loan adding to the total money supply. This can be a good thing, as it makes borrowing easier and can boost the economy. But it's important to remember that this system relies on trust. If everyone suddenly wants to withdraw all their money at once, like during a financial crisis, the system can be strained. That's why it's important for banks to be responsible and for regulators to keep a close eye on things. So the next time you walk by a bank, remember, your money isn't just sitting there, it's part of a much bigger financial dance.